Hello students. So in this session we are going to discuss the 20 plus most expected MCQs on the important topic dividend theories. So for the UGC NET examination, if you are preparing for the commerce or management background, this chapter is common for the both subjects. So it will be beneficial for the both students who are preparing from the commerce or management. Okay. One more thing I would like to tell you that for the best students who are seriously preparing for the upcoming UGC NET examination of December attempt from the commerce and management background, we are providing a complete course for paper 2 in which the experts will guide you to maximize your score in the exam as well as to qualify this examination with a good score and the confidence, right? So in this course we are providing you a complete video lectures which will provide you a whole syllabus coverage. Okay, complete syllabus notes which will clear your concepts of paper 2. Mock test will be provided to you which will cover your unit wise mock test and as well as the combined mock test. PYQs with explanation, doubt clearing sessions and marathon sessions will be also provided to you. So don't late and don't wait to join this course. Just give a message on this number. You can do a WhatsApp message or WhatsApp call and join the course and start your preparation. First question on your screen you can see, according to the Walters model, the dividend policy of a firm is A. relevant for the valuation of the firm, B. irrelevant in the perfect markets, C. based on the capital gains, and D. independent of earning. So right answer is option A, which is relevant for the valuation of the firm. Right. So dividend policy is very important according to the Walters model because it gives the uh, idea or it gives the image about the valuation of the firm. Okay. See, Walters argues that dividend policy is relevant. Okay. The relationship between the internal rate of return, that is denoted as R, and cost of equity, which is denoted as a K. These two factors decides whether retained earning or dividend payments maximize the firm's value or not. Okay. So when R is greater than K, that means internal rate of return is greater than the cost of equity, right? That means the retention is better, otherwise dividend is preferable. Okay, so this thing is very important. When rate of return is maximum, okay, compared to the cost of equity, that means the retained earning, okay, that is better in the company, that is valuable in the company, that means it is preferable, the dividend is preferable. Okay, that is given by the Walters. Next question, who propounded the bird in hand theory of dividend? Okay, remember this word. Okay, bird in hand theory of dividend, who propounded that? James E. Walter, Myron Garden, Modigliani Miller, or Lintner? What is it? This is Myron Garden. Okay. See, Myron Garden developed the bird in hand theory, stating that investors value current dividend more highly than the uncertain future capital gains. Getting it? Investors value current dividend. So basically the people who are investing in the company's shares, okay, those investors value current dividends more than the future capital gains, the uncertain future capital gains, right? So why it is happening? Because this makes the dividend policy relevant, right? As stable dividends increase share price and reduce the perceived risk. Okay, that is the main reason. Here it is why the investors are preferring in the current dividends more than the future capital gains, right? According to the Modigliani Miller, that is MM denoted as a MM hypothesis, the dividend policy of a firm is A. highly relevant, B. irrelevant under certain assumptions, C. always dependent on R is greater than K, or D. maximizing current income only. So right answer is option B, which is irrelevant under certain assumptions. Okay. See, what are those? MM argue that in perfect capital market with no taxes, transaction cost, or asymmetric information, dividend policy does not affect the value of the firm. So these are the factors which are affecting the dividend policy. Which factors? When in the capital market with no taxes, transaction cost, and is asymmetric information that is directly affecting the dividend policy. That means the dividend policy is not working in the firm. Okay. Instead, investment policy and earning capacity are the only determinants of the firm valuation. This is argued by the Okay. Which of the following is not an assumption of hypothesis? A. No taxes and no flotation cost. B. Investors behave rationally. C. Perfect capital markets exist. And D. Investors prefer dividend to capital gains. Right answer is option D. Okay, because no taxes, investors behave rationally, perfect capital market exists. These are the assumptions in a model or hypothesis. Okay, the investors prefer dividend to capital gain. This is not coming under the hypothesis. Okay, see, assumes that investors are indifferent between the dividend and capital gain. Okay, provided the investment policy is unchanged. The other assumptions include no transaction cost, perfect information, rational investor behaviors. Clear? Next. Residual theory of dividend suggests that A. Dividend is paid only if profit remain after funding all investment. B. Dividend is always preferred to retain earning. C. Dividend are irrelevant of the firm value. And D. Dividend decisions should be taken first before the investment. Right? Right answer is option A. Dividend is paid only if profit remain after funding all investment. Okay. Getting it? What does it mean? Dividend is paid only if profit remain after funding all investment. That means retain earning. Right? See, residual theory emphasizes that investment decisions are primary. Okay, investment decisions are primary. Other things are secondary. That means it goes after the investment decisions. Firms should first use profit for financing worthwhile projects, and only leftover earning, residual earning, should be distributed as a dividend. Okay, जो कुछ बचेगा उसका बाद में हम क्या करेंगे, डिविडेंड एज अ डिविडेंड डिस्ट्रीब्यूट करेंगे. This maximizes shareholder wealth by prioritizing growth. Okay, in the Walters model, if R is less than K, okay, the firm should. R is less than K, that means R is equal to internal rate of return and K means cost of equity, right? When the internal rate of return is less than the cost of equity, that means cost of equity is maximum. What will happen? The firm should A. Retain earning, pay out earning as dividend, C. Increase debt component, or D. Reinvest only part of the profit. So right answer is option B. Pay out earnings as dividend. Okay. When the firm's return on investment, okay, is lower than the cost of equity, the reinvestment does not add value. Right. So when the return on investment, the rate of return, correct, is lower than the cost of equity, whatever the cost is happening, expenditure is happening on equity is maximum than the return you are getting, then reinvestment is not the good idea, right? It does not add the value in the firm. So hence it is better to distribute earnings as a dividend, which increases shareholder satisfaction and firm's value. Okay. Next is you need to find out the formula which is given here is used in which of the following model. P is equal to E 1 minus P divided by K minus PR. Okay, which is used in Walters model, Gardens model, hypothesis, or residual theory. It is used in the Gardens model. See, this is the Gardens growth model. What is it? Gardens growth model, where B is the retention ratio, R is rate of return, K is the cost of equity. Okay, it emphasizes that the share price is influenced by the dividend payout and retention policy, making dividend decisions highly relevant. Which dividend theory assumes investors are indifferent between dividends and capital gains? A. Gardens model, residual theory, hypothesis, or Walters model? It is hypothesis. MM hypothesis claims dividend irrelevance provided markets are perfect. Okay. According to them, the way earnings are split between the dividends and retained earning does not impact firm's value, as shareholders can create a homemade dividend. Okay. The traditional view of a dividend argues that A. Dividend policy is irrelevant. B. Investors prefer dividend due to certainty. C. Returned earnings are always superior. And D. Firms should never pay dividend. Okay. So right answer is option B. Investors prefer dividends due to certainty. See the explanation. The traditional approach treats dividend as a highly valued by investors because they reduce uncertainty. Since dividends are guaranteed cash return, investors place a premium on them compared to future uncertain capital gains. Okay, this is the last question. In Walter's model, if R is equal to K, that means R and K are equal, the value of a firm will be becomes infinite, depends on the retention ratio, becomes dependent of a dividend policy, or falls drastically. The right answer is becomes independent of dividend policy. Okay, because here Walter states that when the internal rate of return or return on investment equals the cost of equity, the choice between return earning or paying dividend does not affect the value of the firm, right? So dividend policy in such case is irrelevant. You have to give your answer in the comment box, whatever it is, A, B, C, D, just give your answer in the comment box, okay? Which of the following models explicitly supports the relevance of dividends? A. Walter and Garden models, MM hypothesis, residual theory only, or none of this. So right answer is option A, that is Walter and Garden's model. Okay, both Walter and Garden models conclude that dividend policy influences the firm value. Okay, because which is related to your retained earning, which is extra profit that company is having, right? Walter focuses on relationship between the R and K, the rate of return, the rate of investment, and the cost of equity, right? While Garden emphasizes the investor preferences for current dividends over the uncertain capital gains. So both are explained from the both way, right? And how they are explaining, that is the only result which is concluding that a dividend policy is influencing the firm's value. Correct? So this theory is very important. Next, according to MM, a firm's value is influenced primarily by A. Dividend payout ratio, B. Investment decisions, C. Retained earnings, or D. Dividend stability. So that is your investment decisions. Okay. MM argue that firm value depends on its ability to generate earnings from investments. Correct. Dividend payout is irrelevant in perfect market, but the choice of investment projects directly determines the growth and valuation of the firm. So according to MM, okay, what it is saying, that firms values depend, okay, the firm's values depend on the firm's ability to generate the income from the investment, right? So how much the company is earning from the investment, okay, if it is positive, if it is more, then the firm's value is more. Okay, if the company is not able to generate the income from the investment, that means the company's value is not good. Okay, again, dividend payout is irrelevant in perfect market. Okay, what MM model is saying, that dividend payout, okay, is irrelevant in perfect market, but the choice of investment projects directly determines the growth and valuation of the firm. Because when we have a value, we earn profit. When we have extra profit, we give in the dividend payout, right? So MM is arguing that if the company's ability is good to earn the profit, earn the earnings or returns from the investment, that means dividend payout is possible, it is positive in that firm, right? That the MM hypothesis is trying to say. Which theory emphasizes that dividends are residual decisions? A. MM hypothesis, B. Walter's model, C. Residual theory, or D. Garden's model. Okay, So right answer is option C, that is residual theory. Alright, so residual theory states dividend should only be declared after financing all profitable investment. What does it mean? When you have profitable investment, the investment which is earning more profit or earning more return from that, okay, you should give preference to that things, okay, and after that whatever is remaining you just provide that. The logic is that why it is saying shareholders benefit more from the reinvested earnings than from cash dividends if profitable opportunities exist. If the profitable opportunities are still exist, you should go for it. You should invest in that. You should give your extra earnings to that thing which is earning more profit, right? And remaining, if it is remains, then you can give to the dividend payout and all. Okay, but first you should invest in that things which is profitable for the company, for the firm. Homemade individuals concept is associated with Walter's model, hypothesis, Gardner's model, or residual theory. So that is hypothesis. Hypothesis explains that shareholders can create their own dividends by selling part of their shares if they need cash, regardless of the firm's dividend policy. This supports the idea of dividend irrelevance. Which of the following assumptions is specific to Walter's model? A. No taxes exist. B. Financing is done only through retained earnings. C. Perfect capital markets. Or D. Investors are indifferent to dividends. Right answer is option B. That is, financing is done only through retained earnings. Walter assumes that the finance of a firm, okay, that means the firm is financing only in the investment through the retained earnings, okay, without taking any extra money from the outside, that the Walter is assuming. What difference that makes? This makes the dividend policy directly linked with the investment decisions, okay, which creates the value of a firm, which create the goodwill of a firm. Getting it? So that means the Walter is saying companies should always give preference to the investments through their retained earnings, not to the extra money that company should take from the outside. Getting it? So whatever you have, just invest with that only. Don't take extra money. That the Walter is assuming in a simple word I'm telling you. Next question. The term bird in hand in Gardner's model refers to. What does it mean that birds in hand? A. Preferences for certain dividends over uncertain capital gains. B. Retention of earnings for future growth. C. Ignoring dividend payouts completely. Or D. Issuing bonus shares instead of dividend. What is it? Option A. Preferences for certain dividends over uncertain capital gains. That is your birds in hand, right? Metaphor birds in hand highlights that investors prefer assured present dividends rather than uncertain future returns. Getting it? So birds in hand, that means something you have in your hand already, that should be preferable by the investors. Okay, so investors prefer assured present dividends rather than the uncertain future returns. They don't trust in the future returns, okay, whether it will come or not, but they very much focus or very much interested or preferring to the things which is already the company is having in their hand. That means bird in hand. Okay, this preferences makes dividend policy an important determinant of stock price in the Gardner's model. Clear? Next question. Which dividend model considers growth by reinvestment of earning? A. hypothesis. B. Gordon's model. C. Walter's model. And D. Residual theory. That is your Gordon's model. Okay. Gordon's model directly links growth rate, that G is equal to BR, okay, to retention of earning. The reinvestment of profit increases the firm's growth prospects, which in turn enhances the share value of R is greater than K. That means return and the cost of equity. Clear? If a firm has no profitable investment opportunities, according to the residual theory, it should A. Retain all earnings. distribute earnings as a dividends, lower the cost of equity, or issue more equity shares. Okay, according to the residual theory. Okay, so it should be distributing earnings as a dividends. Okay, first they should distribute the earnings as a dividends, right? Residual theory suggests dividends should only be paid when there are no profitable investments to undertake, right? If the company has no earnings or no profitable earnings from the investment, then company should give the dividends first. In such cases, distributing the earning as a dividend in a shareholder's best interest rather than the retaining the ideal funds. Okay, so companies should not jump into the next investment or more investment than taking the money from the outside, and all these things should not work, will not work. So companies should give the more profits, okay, which the company is having, into the dividend. Okay, which of the following dividend theories assumes a perfect capital market with rational investors? Hypothesis, Walter's model, Gardner's model, or residual theory? That is your hypothesis. Okay, hypothesis is built on the strict assumptions like perfect capital markets, rational investors, no transaction cost, and no taxes. Okay, these assumptions lead to conclusion that dividend policy is irrelevant. This is last question. The value of a firm in a Walters model depends upon A. Only dividend payout ratio, B. Relationship between R and K, C. Residual income after investment, and D. Perfect capital market conditions. I need answer of this question from you. Okay, just give your answer whatever it is in the comment box. In the next session, I will give you the right answer. But before that, I need the answer from your side. Okay.